What's up, Gould Miners? Today we welcome Andy Weiner to the show. Andy is the CEO of RockStep Capital, a real estate investment group that specializes in retail and shopping mall investments. Andy's group currently owns over 9.7 million square feet in retail space across the country. And in this episode, we discuss the ins and outs of retail and shopping mall investments and investment strategy. We start off the episode by discussing how Andy got into the retail investing space and take some time to educate the audience on the nuts and bolts of retail and shopping mall investments. Later on in the episode, we discuss how the rules of investing in retail and shopping malls have changed since the inception of companies like Amazon, and how Andy's group has overcome the challenges, has overcome the adversity, and really used all of these changes to take advantage of the current market. And finally, we conclude the episode with Andy uncovering some of the strategies that can be used to add value to any shopping mall or retail center. Andy is truly a master of this asset class, really knows his stuff. And if you are curious about retail, you've thought about maybe investing in it before, you're wondering, hey, how could investing in retail even be profitable? Isn't retail dead? Well, Andy debunks a lot of those myths and really dives into the strategies that him and his group have deployed to create an incredibly profitable venture for themselves and for their investors. So without further ado, everyone, let's welcome to the show, Andy Weiner.
The Gould Mine Podcast.
Andy, welcome to the Gould Mine.
Thank you. Excited to be here, Danny.
Yeah, man. Well, listen, from one fellow card to another, I got excited, man, when I was like, all right, Andy's going to be on the show. I think you might be the first Stanford alumnus that I've had on this program, man.
Oh, wow.
I'm excited. Took like 60 something episodes, but yeah, no, but here's the thing, right? At Stanford, it's tech, right? It's tech, it's medicine, it's a lot of things, but real estate is something that we've got Spire. I don't know. Are you a part of the Spire thing at all?
I'm not part of the Spire group.
Okay. Yeah, I was for like a hot second, not really in it anymore. But it's interesting, right? How Stanford is not really like super real estatey, right? Like that's for the East Coast schools.
It is not known for its real estate.
Yeah, that's for the Ivy Leaguers. Out here on the West Coast, we're all about our computers. So it's interesting that we're both in real estate, and let's just start there, Andy. I mean, how did you find yourself into, how did you first get yourself into real estate? Currently, you primarily focus on retail, but did you start there? Did you immediately get into retail, or kind of what was that path and that journey for
I started out, Danny. I started out in our family clothing business. My grandfather started a chain of 159 clothing stores. These stores are based in Houston, but the stores are the size of a TJ Maxx, about 20,000 square feet each. Oh, wow. And we had stores in Texas and Louisiana. About half of them were kind of big metros, Houston, Dallas, San Antonio, New Orleans. Half of them were county seat towns. So I ran the operations for the company. That was store operations, HR, logistics, systems, finance, and real estate. Nice. And I decided that's how I got introduced to the shopping center sector. And then I started my own company, RockStep Capital, in 1997. And since then have been focused on shopping center investing for now 27 years. We currently have assets in 11 states. We built or acquired close to 10 million square feet of shopping centers. And we have three product types. We have grocery. We've got what are called power centers, open air centers, TJ Maxx, Ross, Best Buy, Five Below, those type of centers. And then we also play in the enclosed mall space. And most of our properties are in secondary markets. Okay. So that is a little bit of our unique special sauce, is that we focus on secondary, tertiary markets. And in every mall that we buy, every one, we require local investors and a local and a local lender. So we go and we get local business leaders in these secondary markets to be an investor alongside my capital and our existing investor capital, or we won't buy the property. It is part of our due diligence. If we cannot get local investors to believe in Andy, to believe in RockStep, to believe in that asset, and to believe in that community, we'll walk the deal. It's part of our due diligence. And so we're the only ones in the country that require local investors to be in on a mall deal. And we do it to reduce risk. It reduces risk because local investors help us with entitlements, help us with property taxes, with incentives, with relationships to the city, county government officials. Oftentimes, malls become something else. They become an alternative use for all or part of it. And our local investors effectively are deputized leasing agents for alternative uses. They're on the board of the community college, on the board of the hospital district. They're on the board of economic development. We know retail, we know restaurants. We're really piped in, but we don't know as much about what's happening in the medical community, the educational community, economic development. So our investors help us with that, reduce risk, and therefore increase returns.
That's a very interesting model. Now I'm wondering, right, because I'm assuming you're not raising 100% of the equity from local investors.
No, it's a very small part. Okay.
Gotcha.
The equity from local investors is not about the money.
Yep.
It's not about the money. It's about having local business leaders feel that they have a stake in an asset that affects quality of life. Okay?
Yep.
And we're the complete opposite of several other groups who are the large buyers in the mall space, Danny. So the largest buyers are what are called asset depletion buyers. These groups have bought 130 to 150 malls over the last 6 years, and their strategy is asset depletion. Cut expenses to the bones, piss off retailers, upset the communities, don't pay the bills. It's a very profitable strategy, by the way, but it's not ours. Okay. And we are the exact opposite. We're all about community investment, alignment with the community to find out what the community needs for an asset that's usually well located and in many cases needs to find an alternative use for all or a portion of that asset.
Well, it's interesting that you talk about community needs, right? Because retail centers definitely strike me as one of those things that, because I've seen successful retail centers, or you even see successful shops in retail centers, and then you see like the non-successful ones. And usually there's a market, there's a gap, right, between needs and
sure, like
the community needs and like what the retail center is like putting in there, right? So you just said something, right? Because this is like you're the second retailer that I've had, retail guy that I've had on the show. So, but it's interesting that you kind of reverse engineer it that way, right? Where you're thinking, hey, what are the community needs, right? And how do you go about identifying those? And then how do you how does you own the retail center? So you going out to lessees and there's a lot there.
Let me walk through the retail story first, and then identifying needs second.
Okay.
So the retail story, retail has been out of favor till about 2 to 2.5 years ago. Why? Amazon, combined with COVID, has stolen the number of trips that a customer makes to a store.
Yeah.
Basically, home delivery steals trips. Okay. So what happened with Amazon and COVID is it scared everybody away from retail. People wouldn't talk about retail. I'm talking about investors. They were always, the hot subsectors, the hot sectors were multifamily and industrial. Everyone's putting money in multifamily and industrial. Few people were putting money in retail. That's changed. Retail has become a more favored sector for a couple of reasons. Certainly, multifamily and office has its own issues, but multifamily and industrial is facing negative leverage where your cap rate on value is less than the interest rate at which you're borrowing funds. Multifamily is valued at 5.5 cap. You're borrowing at 6.5. So you have negative leverage, which is extremely dangerous. And multifamily and industrial has not faced negative leverage in my career, but it's happening now. Retail has positive leverage. That is, the cap rate at which you're buying an asset is higher than the interest rate at which you're borrowing. So a power center, you're buying at 8 to 9 cap or 8 to 9.5 cap. You're borrowing at 7.25. That's positive leverage. You can add debt onto an asset and it's accretive to cash on cash returns. In the mall space, you buy an asset at a 15 cap or a 17 cap. And when I use cap rate, you're familiar, Danny, what I'm talking about, right?
Of course.
Okay, so 15, 17 cap, you're borrowing at 7.5%, 8%. There you have extremely high leverage.
What are you buying at a 17 cap?
What's that?
What do you buy at a 17 cap? You said shopping malls?
The enclosed mall space is
really
it's typically between 12 and 20 cap on existing.
No way.
So we lever at 50%. So if you lever at 50%, your cash on cash returns, if you get the right debt, which is community and regional bank debt, that's our specialty. So in a perfect world, we get local investors who care about the community, and they're on the board of the community bank.
Right.
And we're able to borrow at 7.5%, sometimes 8%. But if you're buying an asset at a 15 cap and you're borrowing at 8% at 50% leverage, your cash on cash returns over 20%. Okay.
Right.
So you have positive leverage in retail. So retail is more favored for that reason, number one. Number two, Amazon and COVID have really wiped out all of the weak retailers. And those that have survived have figured out how to have their own e-commerce strategy very effective against Amazon. They have e-commerce fulfillment. They've got a great app, and they have a fleet of stores that is very important in a successful retailer. Why? Because a pure play, an Amazon, or let's call it a pure play retailer that doesn't have stores, has an issue with the cost of customer acquisition. In other words, when you start out as a pure play, no stores, the cost of getting new customers is really low. But as you build up over time, you have to start paying for ads. And the cost of new customer acquisition rises so high that it becomes uneconomical. You know, one of the studies is about Wayfair, pure play in furniture. But I've seen a study that said the cost of customer acquisition of a new customer at Wayfair is over $200 per customer to buy a customer.
Really?
The lifetime value of the customer to Wayfair is not $200 less. That's a problem.
Oh,
if you have a store, the store is the lowest cost way to obtain a new customer and also to protect the brand. So pure plays start out only pure play, no stores. And then hundreds of pure plays are opening up stores. Warby Parker is an example. They're opening up tons of stores. Amazon, tons of stores. Okay. So that's what you're seeing all around the country. So Amazon plus COVID killed off the weak guys. Those that survive have great balance sheets. They want to grow, and they're growing into the only sector that has no new product. Look at all the new multifamily. Look at all the new industrial. Before COVID, look at all the new office coming to market. There was no new retail. No one's building retail.
Right.
So everybody is expanding into an inventory that's stagnant. That means if you own second generation retail, you're sitting pretty because you have positive pressure on rents. The cost of new construction is up by 30%. Debt is up by 300 basis points. So the equivalent is that the cost of building with debt involved is up 35 or 40%. But retailers, their sales have not increased by 35 to 40% per store over the last 3 years. They can't afford new construction in most cases. So they're willing to go, they want to go in second generation space. And what's really cool, many of them are going in malls. As you repurpose parts of malls, we're doing TJ Maxx and Ross and Five Below and Hobby Lobby. All these tenants we're doing in mall spaces when normally they wouldn't want to go in malls, but they want second generation space. They can only afford second generation rents, particularly in secondary, tertiary markets. So the case for retail today is dramatically different than what it was 2.5, 3 years ago.
Yeah.
So we are in a different we're in a different world because we are now a desired sector. The other thing that's happened in our business is that there's about $50 billion of insolvent debt coming due in the mall space over the next 3 to 3.5 years. And it's going to get repriced at dramatically lower bases at 12 to 20 CAC on existing income unlevered. So it's going to get repriced. We want to play in that space. But the big change is that you used to be able to syndicate a deal and successfully acquire an insolvent mall. Can't do it anymore. Okay. The lenders, which are driving the process for bringing these properties to market, are requiring that you have committed capital. And as a result, we're moving to a fund model. Hometown America is our fund, $50 million closed-end fund. It's 5 to 7 properties where we're targeting an 18% plus IRR with an 8 to 9 pref. So our company is going from a syndication model. Every deal we've done in all 11 states have been through syndication. We're now shifting to a fund model. And the reason is you cannot get the best deals unless you have committed capital.
Well, that's very interesting. I've never heard of that. What? That makes no sense, honestly. What's the reasoning, or what's the?
What do you say? What does not make sense?
Well, it doesn't make sense why the lenders are now requiring committed capital. What's the rationale, or what's the reasoning behind that?
They want assurance of close.
I see.
They want assurance of close. They don't want you to have trouble putting your syndication together. And so what happens is, if we're competing against 3 or 4 other buyers who can play with committed capital, not 50 or 200 buyers. That's why we're able to get such good deals.
I see. It's not all shopping malls. It's not all retail centers. You're saying it's specifically
about the enclosed mall sector.
Yeah. Okay.
Now, when you play in the power center space, there you're buying property at 8 to 9.5 cap, and you're competing against 10 to 50 to 75 buyers. There's a much larger buyer pool. You have to move fast, so committed capital helps. Most of the time, syndications don't work.
Why is it that the enclosed mall space is trading at such a high cap rate nowadays? Is it because of everything that we just discussed with
There's another factor.
Yeah.
Debt. Debt is hard. Okay.
Gotcha.
And because it's very hard to get debt in the mall space, it makes it harder to buy. You've got to buy them cheaper. Okay. Now, when we buy property, we bought a property in Kansas at a 17 cap. Okay. We put 50% leverage on our, debt service coverages. Okay.
DSCR.
Yeah. So debt service coverage typically in a real estate loan has to have a minimum of 1.25, 1.35 debt service coverage. We're typically at 2.5 or 3 times debt service coverage.
Interesting.
And so lenders who normally think the mall is a bad word look at this and say, hey, I've got 50%. I got 3 times coverage, better than any loan in my whole loan portfolio for a property outside my window. And I know 4 of the investors, 3 of them are on the board of this bank. I'm all in. So we work at it from a local community and regional bank as well as a local investor strategy. It all has to line up. A couple other things I'll tell you about our company. We're vertically integrated. We have a team of 65 employees. That means we do our own property management. We do our own leasing, our own acquisition, our own underwriting, disposition, construction management. Everything is in-house. The other thing I will tell you, just again, background information, you probably don't know what the word RockStep means, but it's not in the dictionary, but it is a dance move. So I like big band music. I like swing music. Frank Sinatra, Ella Fitzgerald, Peggy Lee, Rosemary Clooney, Sammy Davis Jr., 50s, 60s, genre swing. So when you do swing dancing, you switch directions on count 7 and 8. 1 to 3, 1 to 3, rock, step, ball pivot change. If you're married, I don't know if you're married, you might have danced at your wedding, you were rock stepping. So at our company, our goal is to be nimble, light on our feet, listen to the music in the industry. Okay. And the music in the retail industry is changing all the time, and be very responsive. Hey guys, Danny, we got a problem at this property. We need a rock step. Everybody at our company knows what it means. We use it as a verb. The other thing we have at our company is we have 25 rules of behavior that I'm very religious and strict about. These are rules that if you are working at RockStep, you are required to live by these rules. I wrote every rule and every sentence associated with every rule. What do you think we call these rules? Come on. Too bad. They're called rock steps. Okay.
Okay. I thought that was going to be it, but
here they are. And we have a rock step of the week. So every 25 weeks, we go through each rule, rock step for the week. This week is rock step 24. Keep family first. Actually, we're talking about this. So yesterday, Monday, 10 o'clock Central, everybody in the company at 10 o'clock Central is on a Zoom call talking about the rock step of the week. Keep family first. Take care of your family and your health. As crazy as work can become, never lose sight of family as a priority. The healthier we are, the happier and more productive we become as well. This is one of my favorite 3. If you don't take care of your health and you don't take care of your family, you cannot take care of RockStep. And so we require everybody to live by these 25 rules. It's how we hire. It's how we fire. We're not perfect. So my favorite 3, I'm going to go through them real quick. Do the right thing always, RockStep number 1. We're in the investment business. It's a world of gray. You always have to say, what is the right thing to do in this situation? What's the right thing to do for the investors? My next favorite is RockStep number 3, be punctual. On time is 5 minutes early, and on time is late. Okay. And our company is really punctual. And then my third favorite.
I was very late today then, wasn't I, Andy?
No. But, and I'm going to show you something. Okay. So, if you're going to run late, you have to be courteous and do exactly what you did. No one's perfect. So you're fine.
Pass the
and
test.
My other favorite rock step is RockStep 24, keep family first. I'm going to tell you my most challenging rock steps. RockStep number 7, listen generously. I don't think men listen as well as women. My wife will tell you I'm a terrible listener. I'm always thinking about what I want to say when somebody's talking, and I interrupt you. It's a terrible habit. Terrible. Number 8, RockStep number 8, speak straight. I don't like confrontation. Okay. I don't like, Danny, we got a problem here. I don't like X, Y. That's not my style. Okay. And then RockStep 25, have fun, which is our RockStep of the week next week. As my wife, I'm very serious. As my wife says, I take the fun out of fun. Okay. So I'm just very serious. So anyway, as we talk about our company and our people, our team is extremely high performance, and we live by these rules. We talk about this. It's the language we use. We're required to live by these rules with everyone at RockStep, with people we meet, with our communities, with our lenders, with our tenants, with our lawyers and architects. Everybody, we're required to live by these. So it's not exactly on subject, but it's core. I mean, it is to the mat, core, hardcore of who we are.
Yeah, I love that, man. And I do believe that it's relevant because when, actually the guest that I just had on earlier, him and I were talking about how, we want to look at these numbers on a sheet, right? And these pro formas, but the pro formas don't tell you the real story. The what's driving the pro forma are the systems and the people behind it. Right. And so what you just described, right, you have a set of beliefs, you have a set of core values, right, that you've given to your really organization, and those people are driving them.
It's a set of behaviors that we require. Yes or no. Don't be a jerk, RockStep 22. Be a fanatic about response time. Be a careful steward of our assets. That was last week, RockStep 23. but we have rituals around them. So every Monday we talk about the Rock Step of the week. One person writes an essay about what it means to them personally. They lead the discussion for the whole company. And then somebody else randomly chooses other people on the call to share. What does it mean to you, Danny, to keep family first? Okay. What does it mean? What does it look like? And why is it important? And so everybody needs to think about this all the time. And it's the language we use. Hey, Danny, got to speak straight with you. Got to speak straight.
That's awesome, man. No, I really appreciate you sharing that. And coming up with the next topic here, because there's so many different, I want to take it in like a variety of different directions, but you mentioned transitioning to a fund model. And I'm wondering, right, just from like a logistics standpoint, not that it's super relevant to like, say like LPs, right? But like definitely anyone who's listening to this, it's more like on the active side or like syndication or GP side of things. How is this new fund model going to support or work in tandem with the local raising funds from local investors?
Great question. So here's how it's going to work. So the fund will have 5 to 7 assets. Okay. At the asset level, local investors can invest only in that asset. They're not going to be required to come into the parent, into the fund.
Gotcha.
In addition, if we need larger amounts of equity, we can have a family office or institutional investor come in at the asset level. So there's co-investment at each asset. The fund is going to be investing in each of the assets. And there's co-investment opportunities at each of the properties.
I see. Yeah, that makes sense. And at the end of the day, right? Yeah, no, that makes perfect sense. And well, in my head, I was thinking, well, like, okay, is the lender requiring a full capital commitment up front? Well, you've got the funds. Doesn't necessarily mean that you have to use those funds, right? You can still source or syndicate outside capital. Okay, that answers that question. That's super interesting.
Let me walk you through a typical a sample acquisition that we've done, just to kind of give you a flavor about how we put this thing together.
Sure.
So Manhattan, Kansas is the home of K-State University. Yep. And we bought what is called Manhattan Town Center. It was a mall. It is a mall. We bought it from a national company, and we bought it at a 17 cap. Paid $14 million for it. Okay. And we put on 50% leverage with the local community bank, of which 3 of our 4 local investors were on the board. And one of our other banks was a participant in Kansas. We own other property in Kansas. And so we ended up with great local investors, and we bought a property at a 17 cap. We pro forma, we bought it at 1.95 million of NOI. Plus there was some incentive money that was coming in from the previous owner. We budgeted 2 million flat of NOI for 5 years and exiting at a 16 cap in 5 years with flat NOI and exiting at 16 cap, which is 1% lower. But we also are a believer that if you have stable NOI, you'll have more debt available to the property. The reason why debt is very hard is that lenders don't think that the NOI is stable in a mall. Yep. So if you show stable NOI, you exit at a 16 cap, you'll end up with a 16 IRR on the asset. So we bought in end of 22. So this year we're going to end up with NOI at 2.75 million.
Nice.
Okay. We returned 20% of the original capital without a refi. That's after the 8 pref. We paid the 8 pref and then returned 20% of capital. This year, we're going to pay the 8 pref again and return another 20% of capital without a refi. We're paying down our debt on a 20-year AM. So we're having value in paying down the principal on our loan. We'll end up well in excess of a 20 IRR on this deal. Okay. And that's without anything unusual happening. Our goal is to replace pennies. Penny's is not doing well, but they're paying rent at about $3 a foot gross per year. That's less than your net, so it's basically free rent. And we'd like to buy them out and close them down. We have 3 other tenants that would pay $50 to $18 a foot with excellent credit and come right in behind it. Now,
really,
and the reason I bring that up is we didn't underwrite that. You never underwrite the ups. You only underwrite a base case.
Yeah.
Okay. You don't underwrite a reduction in property taxes. You don't underwrite the ability to replace a tenant for higher rent. You don't underwrite the ability to demolish a piece of the shopping center and get permits from the city for 200 units of multifamily. Those are all ups, but you never know if you're going to get them. So you have to have a base case underwritten conservatively as if nothing good's going to happen. And then when you buy it, you should be able to execute on some of the good stuff.
Sure.
It's gravy. So our strategy is underwrite a base case. The base case has to be mid to high teens IRR with nothing good happening. And then work on making the good stuff happening. So, for example, property taxes are political. It's a political issue in many markets. So we bought one property at $12 million and the taxes were valued at $35 million. Very political in that market. One of our investors was very connected to the city, said, Andy, let me take care of this. And that's how it's done. Okay.
Yeah.
So the other thing that we've been very fortunate with is getting incentives. So we've been able to get incentives in New Orleans, in Kansas, in Nebraska, in Minnesota. We're working on an incentive package in Louisiana for another property right now. Incentives are very important. And in many cases, our local investors help us with incentives. So in our New Orleans property, we bought the Riverwalk from the Howard Hughes Corporation. It's right on the Mississippi River. It's where the 1984 World's Fair is. It's a 2,000 foot in length shopping center. Okay. It's one long shopping center where the World's Fair was in 1984. We're right at the end of Poitras Canal, right on the water. So our goal is to redevelop Spanish Plaza, which is the plaza at the end of Poitras Canal on the Mississippi River. And we got an incentive from the city that is going to give us an annuity between $1.5 million and $2 million a year, unbudgeted. And our local investors got the incentives for us. I didn't do it. Okay. I couldn't have done it. The odds of me as the out of town guy getting it done are dramatically lower. Okay.
Yeah.
Dramatically lower. And so whenever there's a community angle, whether it's property taxes, incentives, trying to get somebody to locate at our property that's a community type of use, having local investors absolutely makes a difference.
So here's my question, because it's one thing to source local investors, but you're sourcing local investors, it sounds like, with a lot of clout and a lot of pull and leverage. So how do you source these local investors? Do you have a system and a process that you use every time, or what does that look like?
It's all networking, Danny. So I talk to the mayor, city manager, head of economic development, the presidents of the local banks. Sometimes I know investors already in those markets and they'll network with me. They'll network their friends. And I develop a list of people who care about the community. And then I tell them my story. Here's the deal. You can invest locally. If we don't buy this, there's a possibility, maybe even a probability, that one of the asset depletion guys comes in. Okay. And we target an 18 plus IRR. You show me where in real estate you can find that, and you can invest locally in an asset that affects quality of life. That story works. That story is appealing. And if you like what we're doing, you can do this in other hometown markets. So we call our fund Hometown America. It's secondary, tertiary market. It's not the Houston, San Francisco's, Dallas, Atlanta's, Chicago's. It is hometowns where there's a community that cares. I'm not saying there's not a community in Houston that cares, but they don't have stroke. It's just different. There is something about hometowns that are unique. People really, really care, and they spend their time, energy, and financial resources to make the community great. And we want to be involved in those communities.
Yeah, that makes a tremendous amount of sense. And it also, I mean, it just feels very tactical. It feels very intelligent, to structure it this way. Yeah, you're clearly doing your investors, both the local, but, more importantly, the people that are like outside of the community, like you're creating massive value for them because you're basically, you're finding a way to really like create a lot of leverage with the local decision makers. And that really does go a long way. I mean, especially for something like this, right? Like I would assume, Andy, and correct me if I'm wrong, but I would assume that maybe this strategy wouldn't work as well for, say, like a multifamily guy, right? Like someone that's just trying to do like an apartment building or...
No, because the enclosed mall is the only one in the community, and it's symbolic. If you have a multifamily, you got 50 projects. There's nothing unique about it. Okay.
Yeah.
But the enclosed mall is, in many cases, needs to be transformed. Okay. And and it affects quality of life. If it goes dark, can that community bring in all the doctors and the doctors' wives, the doctors' spouses, when it looks like crap? Okay. It is actually a big issue. So one other thing I want to talk about is that many of these malls, so how do you create value in a mall? One, you can have a steady Eddie like in Manhattan. It's fine the way it is. You have others where you shrink the amount of retail and you do something else there. So in Janesville, Wisconsin, the city's investing $50 million to build 2 hockey arenas. To build an indoor sports complex with 2 sheets of ice for the semi-professional Janesville Jets hockey team. In addition, 40,000 square feet of that indoor sports complex will be a community center and a conference center. So that's on our property. We're going to demolish everything but the Kohl's, Dick's, Ulta, and Chuck E. Cheese, and we're going to put a hotel, and we're going to put multifamily. So that property, great location, we're changing the nature of that property. So that's something else you can do. Another strategy is, so you got Steady Eddie, you've got repurpose, you also have arbitrage. So you can buy a property at a 20 cap, but let's say you've got some restaurant ground leases around the perimeter, sell those off at a 7 cap. Very, very profitable when you do that. So the sum of the parts is greater than the whole. The periphery is more valuable than the non-periphery parts of that. So you can do an arbitrage strategy. You can also demall. Okay. You could actually go and just demall. We're demolling 4 properties right now, 4 of our malls. So in Scottsbluff, Nebraska, in the middle of nowhere, okay, town of 25,000 people, we brought in Dunham Sports, Hobby Lobby, Dollar Tree. We opened Harbor Freight. We're just opened up Ross. TJ Maxx is coming in. Five Below is coming in. 2 more national tenants are coming in into that market. And we're using the architecture of the mall to create second generation space and provide second generation opportunities for these tenants that couldn't afford new construction. So the region of the Panhandle, it's called the Western Panhandle of Nebraska, is getting a quality of life infusion where they don't have to drive 120 miles to Cheyenne. That's big. And we're demolling that property. Everything's going to face out. Okay. We're going to basically.
Is that what demolling? Is that what demolling means instead of indoor? It's you create exterior facade.
Demolling. One is you face out everything. We're doing that in Hutchinson, Kansas, and in Scottsbluff, Nebraska. And then you have the interior. Let's call it 100,000 square feet. You basically sell off to a storage guy, a local storage guy for cheap. So they can have 100,000 square feet of storage for $1. Okay. And you sell it for $1, the NOI goes up because it costs a couple $100,000 for taxes and insurance. So you sell the interior for $100. For $1, your NOI goes up by $200,000 on the property because the cost of maintaining the interior. In addition, a property that's valued at 15 cap becomes a 9 cap or 8 cap because it's a power center.
Right.
And your NOI goes up by selling the property to a storage guy for $1. So we're doing that in 2 properties.
That's very interesting.
And then 2 others are driven by big retailers that are coming in. We're demolishing everything and bringing in the new route of retail. Retail has started to expand again. Walmart, Target, Costco, Home Depot, Lowe's, they're all expanding. They have capital to do new construction. The other guys, the TJ Maxx, Ross, the guys that lease, they would prefer second generation space. And one of the reasons why retail's in favor today, it used to be 4 or 5 years ago. Let's say you had a Barnes & Noble. Barnes & Noble is paying 20,000 square foot building. How do you underwrite a Barnes & Noble? So at the end of their lease, are they going to stay or are they going to go? Is a company going to go out of business? So you say, okay, their lease is going to go. What do I do? Is that space really $12 a foot or $15 a foot? Now, you don't want Barnes & Noble to relocate across the street to go out of business. Or you want them to go out of business. You want them to leave. Before, you didn't want them to leave. You weren't sure what to do. Now you want them to leave because you got 5 tenants that will pay you $18 to $20 a foot with better credit standing behind. Because there's no new construction and you have a whole slew of people that are expanding with great credit into an inventory different than multifamily, different than industrial, where there's no new product.
That's very true. No, that makes a lot of sense because you don't really see a lot of retail popping up. And I would imagine even less so in like the secondary and tertiary markets, which is your focus. You know, I've got another question for you
really
here,
don't
Andy.
see it in the major metros much. It's starting a little bit. In the major metros. Not a lot. Very, very little.
A little bit of development. So, question on the malls, and I guess we could break this up because it sounds like the economics of an enclosed mall, right, are slightly different or maybe vastly different than like a power center, retail center, strip mall, whatever. What are the because you tossed out a number, 1.95 NOI, you raised it to like 2.6, 2.7. What is that in terms of percentages? Like, what are the margins like, and what are the expense ratios like on a retail center and a shopping mall? Because I would assume that they might be fairly expensive, but I don't know, depending on how those leases are structured.
Typically, and we're not talking big metro, but typically a power center is $3 or $4 a foot of nets. Okay. So if the center is 100,000 feet, it costs $300,000 to $400,000 for taxes, insurance, and maintenance. In a mall space, typically we're finding that the nets are between $3 and $6 a foot, with New Orleans being an exception. In New Orleans, what we have found is that property insurance has skyrocketed, and particularly along the coast
because of the hurricanes.
And so our nets are dramatically higher in our coastal properties because of property insurance. There's simply been a lack of reinsurance capacity. And as a result, insurance rates are higher for less coverage. That's a big issue.
And interesting. So you're saying 3 to 6 on average for the enclosed malls. And so it basically, so that's
enclosed malls. For our enclosed malls, the bigger enclosed malls, Simon, might be $20, $30, $40 a foot. But the ones we offer.
I see. Okay. Understood.
Yeah.
And so what it boils down to then is those are fixed costs, right? Because it's not like, those are all fixed regardless of whether it's, 100% leased or 50% leased. Those are going to be fixed costs. So, what it sounds like is based on the rents that you can get per foot, that arbitrage is usually profit because there's not much additional expense per. Okay. Makes sense.
There's virtually zero expense. So if you get one more tenant at $100,000 a year, that is straight to the NOI.
Yeah. Very interesting.
Yeah.
Very interesting.
Our fund, one of the things I want to mention, Danny, is that our fund is going to combine both malls and power centers. Because we do both. Malls is where the opportunity is, but there's a little bit more risk in malls. Power centers are more stable, but the returns are a little bit lower. Typical power center is a 13 to 15 IRR. I'm talking about with reasonable conservative underwriting.
Leverage.
Yeah. Okay. Well, and leverage. Yeah. I mean, we typically will put 55 to 60% leverage on a power center, 50% on a mall. And I mean, we're very conservative on how we analyze the rent flow over the 5 years, and we're very conservative on our exit cap rate as well.
I feel like we need another hour, but we don't have it. So
no, it's good. No. This is a lot of fun, Danny. I love talking about this space. It's a different model. This is a boring cash flow play. That's what this is. It is boring cash flow with a heart and soul of hometown America. That's who we are.
Well, I wouldn't necessarily say that based on this conversation. I think it's boring. I think that there's a fairly significant amount of strategy involved from what you're saying. And it also sounds like the networking aspect of this, at least in your business model, is it's a lot more important than in a lot of other asset classes. And so I think that there's definitely maybe some more backroom stuff that needs to, there's more, instead of it being like a lot of grunt work and, hey, let's just, let's reposition this whole building and, construction and everything. I'm sure there's a fair amount of that too. But there's also, it sounds like some strategy and some networking involved that you don't really see like in a lot of other asset classes. So it is quite interesting to me. I think that you're downplaying it.
We want to take a tremendous amount of effort to reduce risk at the beginning. Yeah. And again, if we don't get a local investor group, we will not buy them. It's part of our due. It's like checking the roof. It's like interviewing all the tenants. If we can't get anybody to believe in that asset, that city, Andy and RockStep, that sends us a negative signal. We want to succeed. We are about reducing risk. That is who we are. We will take tremendous effort all along the way to reduce risk.
Love that. And by the way, if you are wondering how to get in touch with Andy, or if you're curious about anything that Andy's discussed up until this point, all of the links will be in the show notes below. So go ahead and feel free to check them out. And Andy, this has been.
Please put my mobile number there and my email, and have anybody reach out to me. I love, if you see opportunities, Danny, we're always trying to hire. We're trying to hire people who will live by the rock steps, who also are professionals in the real estate industry. So we are hiring a lot of folks. It's a really fun time right now as we transition to a fund model. It's a great opportunity for us to grow even faster and take advantage of basically all these properties on the clearance rack. They're on the clearance rack.
Yeah, no, it seems like an asset class that is ripe with opportunity, and definitely, definitely seems like there is quite a bit of like arbitrage to be had there. So really interesting stuff, Andy. This has been awesome. And before I let you go, though, as is tradition here at the Gould Mine, we're going to have you leave the audience with one final Gould nugget. Take it away.
One final Gould nugget, and that is that hometown America is a really special place. People who care about these communities, there is a sense of community. We love working in hometown America.
That's awesome, man. No, and I think that your investment strategy proves that. The everything that you've discussed today, I think, really demonstrates that. So. Andy, I can't wait to have you on again for part 2. Sure, this won't be the last time that we chat. And until then, go Cards,
Dave. Go Cards, Davey.
Here we go.
Make sure you have your good CrossFit workouts. Have a good one.
There we go. Yeah. All right. Let's go.